Well, FedEx reported strong second quarter results with gains that were driven by higher shipping yields, stronger domestic package volumes, and continued progress on cost-cutting initiatives. Joining us to break it all down is Jeffrey Kauffman, equity research analyst at Vertical Research Partners. And Jeffrey, thank you very much for joining us.
Thank you. Good morning, Roger.
What led the way amongst the things we just said there? What was the biggest factor, do you think?
I thought you hit it pretty well. I think the surprise to investors was that peak season finally showed up, and they were talking about holiday volumes up mid-single digit. I think the company did a terrific job of growing revenues a little bit better than the consensus was expecting by almost 3.5%. They did it through a combination of volume was better, yield was better. They're ramping up some of their Amazon business. And at the end of the day, it was a very solid result for the parcel and express part of the company. The less than truckload business continues to struggle because domestic manufacturing's been weak, and we're seeing that in competitors such as ODFL and XPO. So we're not surprised that the LTL volumes were a little bit light, but for the second quarter, the express business did offset the negatives on the less than truckload trucking side.
And with this margin improvement, is it something that can continue, or is this just more cyclical?
I think it can continue. I mean, especially since it was both volume and yield. It wasn't any one thing, and it wasn't even so much the cost cutting yet, because they still have a lot of their integration of facilities still to do. And that's going to be the next 6 to 9 months. I think only about 30% of the integrations have been completed. So you're going to go from 1,300 facilities to about 800 facilities combined between express and ground parcel. So there's going to be significant cost savings as we go into 27 and eventually into 28. So we really like what we saw. I think the reason the shares are in the red today, not the green, is because they did announce, along with the really good earnings, that it was going to be more tempered next couple quarters because of expenses related to the spin of the LTL business that will happen in June, as well as kind of a problem of success, higher variable incentive comp to the employees based on them exceeding targets in the express business year to date.
Any concerns with that LTL when it comes up in June?
No, I think they're one of the leading businesses. It's a great business. The entirety of the U.S. trucking business has struggled for about 2-3 years. I think some people call it a freight recession. We just kind of look at it as more of a lack of consumerism and a lack of manufacturing activity. But this business in the long run is going to be fine. They have one of the better operating subsidiaries in the country. And the way we look at it is, with the spin coming in about 5.5 months, you really need to look at this on a sum of parts basis. Based on the earnings we think the LTL company is going to generate and peer group valuations, we think the LTL business is worth about 110 per FedEx share today. Mm-hmm. So if you work backwards off the current stock price at 274, that means you're paying about 10.25, 10.5 times earnings to own the parcel company, or what we would call RemainCo. And we don't think that's the right multiple. They showed us today or yesterday that business is good. They're expanding margins. They're growing share. I think that's a business that should trade between 13.5, 14 times earnings. So we think that business is worth about $230 a share post-spin. And when you combine the two, that's about $330 per FedEx share. So, we do see upside even after the run the stock's had for shareholders going into the spin.
Do you see them getting to that multiple that you'd like to see?
I think so. We always get low multiples when freight markets are slow, and those multiples always come back when freight markets normalize. So I would view that multiple as really nothing more than a cyclical bottom in an industry that kind of depends on global trade.
And speaking of that, is that global trade, is that any kind of a headwind, concerns for a headwind there?
It is over the near term. If you segregate the results in the parcel business, the domestic parcel business grew 5.5%. It was very strong with solid volume and solid yields. It was the international part of that business that actually declined about 2%. And I think that's something they're going to continue to work through because there was some pre-shipping that occurred ahead of the tariff deadlines. And you've got some very difficult comparisons over the next 6 to 9 months because you'll be comping against those strong periods. But I think when we get to fiscal 27, we're going to be through those difficult comparisons, and we're going to have a business that's going to be restructured and generating better margins and generating better cash flow. And I think investors will look at that and say, wow, this is a good business. We should probably pay a little more to own the shares.
Okay, we'll wrap it up there. Jeffrey, thank you as always for joining us.
Thank you.
Jeffrey Kauffman is equity research analyst at Vertical Research Partners.